It was recently reported that Chris Wood of Jefferies stated that Sensex could reach 100k within 5 years. The same was stated by ace investor Samir Arora in 2021. In addition, a host of market luminaries are predicting that the Sensex will be able to hit 100k between 2024 and 2028. Nevertheless, I have a feeling that it might reach 100k within 3 years based on my scientific analysis and also gumption. How does Sensex anticipation around 100k come about and what is the story behind it? That's what we are going to discuss as a part of detailed analysis today. When we think of India, we need to think of the structural story. Considering that the structural story of India is still intact, one may expect that Indian stock markets can continue to climb the proverbial wall of worry and reach the 100k mark. For India to qualify as a 100k league in terms of indices, the companies in India must have an EPS growth of 15% over the next 5 years and 20x PE multiple over the next 5 years. We all know that the Sensex has been trading sideways for the past few years, and we all are aware of the fact that there has been an upward trend in earnings growth, which has allowed valuations to catch up with earnings growth. In that sense, it can be said that India is not as expensive as it was a few years ago, both in absolute terms and in comparison with other regions. It is important to note that the Nifty premium to Asia's Japan is close to the 10-year average of 38% when compared to 1-year forward PE of 18x, which is only slightly above the 10-year average of 17.4x. I think for the next 12 months, the key risks to be aware of are any changes in the current consensus for the BJP's re-election next year or any further reduction in retail investor activity after a period of range-bound market activity. The fact remains that a democracy like India is inherently risk-free so long as the long-term story and underpinning economic initiatives that are shared between all political parties in the country in terms of development and any kind of changes that are transitory in nature. An important positive factor is the sustained inflows into domestic equity mutual funds, the majority of which are from SIPs, that is systematic investment plans. In the past year ended April, domestic equity mutual funds received a total of $20 billion in net inflows. In contrast, household assets amounted to an estimate of $11.1 trillion as of the end of March, with equities making up 4.7% of that amount. On the domestic front, however, the risk factor is the reduction in retail investor activity after stock markets have traded in a tight range. Active brokerage accounts have fallen from a peak of 3.8 crore accounts in June 2022 to 3.1 crore accounts in April 2023 as a result of tight markets. There is, however, a need to keep this under control. The trend of foreigners resuming buying in Indian equities as net buyers over the past few months has been as a result of their retreat from China. In the 3 months to February, foreigners sold a net of $4.5 billion worth of Indian equities, while since March, they have purchased a net of $7 billion worth of Indian equities. In relation to the history of emerging markets, dedicated investors now only appear to be slightly overweight on India as compared to few years ago. There has been an issue in that the given size of India's economy, the neutral weightage given to India in the MSCI benchmarks has always been inappropriately low, especially given the size of the economy and the purchase power parity. Despite this, India still only makes up 13.2% of the MSCI benchmarks in the region. I believe that monetary tightening may be all but over as inflation has fallen in recent months, indicating that it may be all but over. In the last few months, headline and core CPI inflation has declined from 6.5% YoY and 6.1% YoY respectively. The headline inflation in January was around 4.7% YoY and CPI inflation was around 5.2% YoY. In April, the Reserve Bank of India has kept the repo rate unchanged at 6.5% in its monetary policy meeting. According to the current estimates, the inflation rate should remain around 5% for the rest of this year, which is below the upper band of the RBI's target, which is around 6%. Moreover, what we need to note and feel pleasure is that the Nifty Private Banks Index has increased by 1073% in US dollar terms since it was launched on April 1st, 2005, whereas MSCI has decreased by 20% over the same period of time. So, India's Nifty Private Banks Index has showered fabulous returns to FIIs, domestic investors, and also to retail investors. That's quite an exceptional trend when compared to the world trend as such. It is also worth noting that the last few years have also witnessed a dramatic deleveraging of corporate balance sheets. The corporate debt to equity ratio for large listed companies is 0.6x, the lowest level since FY 2006. However, since Narendra Modi was elected as the Prime Minister of the country in 2014, there has been an increase in popular aspirations and expectations. A huge rise in India's self confidence as a country has also been a consequence of the rise in its confidence. Upgrades in infrastructure, targeted welfare distribution through technology, and the success of the unified payments interface are some of the most positive aspects of this government in office right now. Another example is the near completion of two dedicated freight rail corridors, one of the greatest achievements of the current government. So, given the positives and given the expectations, given the expected EPS rise of the Indian companies in next 5 years, and given the PE multiple becoming more attractive, it's beyond doubt for anybody to say that India's Sensex is nearing to reach its targeted 100K mark in a short span of time. One needs to have the fruits of the gains that one can find while Sensex find its way to 100K mark. Hope the information is useful to you all. Thank you very much.